Hi, my name is Rootshtain. I'm a portfolio manager with Sasfin Asset Managers and assist in managing our Sasfin Flexible Income Fund and our High Yield Fund. And want to share with you a short market update, trying to make sense of our current economic environment, where we find ourselves currently in the cycle of interest rate hikes, and how we at Sasfin are positioning ourselves in these turbulent times, trying to look after your assets and take care of your investments. So I guess really the first part of it is really the global backdrop, where coming out of COVID, as we all know, we saw massive inflation that found its way into the global markets. We in South Africa as well had massive spikes in inflation, food prices, petrol prices, and the like. And on the back of that, most central banks, all central banks almost, embarked on a very aggressive hiking cycle to try and bring this inflation back under control. This Federal Reserve, the US Fed, which is probably, I guess, the leading indicator in terms of the response to this inflation crisis that we all experienced, has increased rates very aggressively over the last year and a bit, and still at the moment not certain whether they've reached the end of their hiking cycle. And typically what we've seen and found, whenever the Fed hikes rates so aggressively, we normally do find that something in the economy lands up breaking. For example, in 2008, we had the global financial crisis off the back of aggressive rate hikes that took place then in 2006, 2007. Recently, we've seen in America the regional banking crisis, with numerous defaults of banks unable to meet their obligations and having to be bought out by bigger banks and rescued by the authorities in America and come to their savior. That's one thing that's broken over there. And as a result, many market commentators, there was a survey with Bank of America recently where I think almost 90% of those participants who were surveyed expected that the US would tip into a recession as a result of this aggressive hiking of the Federal Reserve. And once that happens, that often has the follow-on effect that the entire global market lands up tipping into a recession. Here in South Africa as well, we've also had our own challenges. Recently, we've had our Eskom crisis, where we've seen continuous load shedding at stage 6. Eskom recently announced that we're very likely to experience stage 8 load shedding this winter, which is almost unthinkable, but it's almost like 14 to 16 hours of load shedding within a 26-hour period. And you can imagine the impact that will have on our economy, the manufacturing sector, the mining sector, our ability to produce goods and then export, the impact that has on households and small businesses. And that's just devastating for our economy when one thinks of the impact that this has on our economy locally, and not exactly like we're in good shape as it is. So, just like another blow to us to think that we're going to go another 2 stages up and possibly for the most of winter is really a tough blow to handle. So on the back of that and the realization of how difficult we are locally on the back of this electricity crisis, we saw locally our currency and our bonds already displaying a lot of volatility. On the one hand, because of the volatility that we're seeing coming out of America and the uncertainty and the expectations of them tipping into a recession, as well as locally, on top of that, the perfect storm, where we've seen on the back of our electricity crisis, the forecast growth expectations that we're likely to see almost no growth this year from GDP and in the economy as a result of the extreme load shedding. That really just tipped our currency, already in a weak and difficult environment, almost over the edge. And we saw a sell-off in our bonds and our currency recently as a result of that. To make matters worse, when was it? Last week, the week before, when the American ambassador came out with an announcement that South Africa had assisted the Russian government in procuring arms, and our policy of non-alignment doesn't seem to be holding up, and we do seem to be taking sides and assisting Russia in a war, something that the Western governments and the United States especially doesn't view very favorably. And on the back of that announcement, we saw a further sell-off in our currency and our bonds, with our rand reaching the worst level ever against the dollar, almost at 1950. And our bond yields also sold off terribly aggressively, where we suddenly saw our 10-year bond selling off from about 11 and tipping and reaching even a yield above 12% on the back of that bad news. And as we position ourselves and as we now start thinking through what the likely outcome of both perhaps the policy missteps, if we'll call them that, of our government, the very precarious economic environment we find ourselves on the back of load shedding, we have to now try and understand and determine how weak is our currency, how much of the bad news that we're expecting in terms of a potential recession and all of the bad news that's filtering through on the back of this Russia misstep, how much of that is now already priced into our bonds. On the one hand, if you would look as a fixed income investor, where probably the biggest determinant of your return in a bond over the longer term is the yield to maturity at which you purchase that bond. So if you can buy a 10-year bond at 12%, and our long-term inflation forecast is that we're likely to see inflation closer to 5%, so then that's perhaps an opportunity to get into an investment that's going to offer over the longer term a real yield of approximately 7% for investors. And that's a phenomenal return. If you think as an investor, you can almost get investing in a government bond, which is pretty much and it's pretty much the closest thing that you can get to a free lunch in the investment world, is investing in a government bond that's very unlikely to default, and you can get a real return above inflation of 7% for an investor. That's a targeted return that even in a high equity fund, managers would be very jealous of such a return. So that's on the one hand. We know the MPC is meeting this coming Thursday and will decide whether they're going to be hiking our interest rates further. The consensus in the market at the moment is that although we are already at a very elevated rate in terms of our interest rates, and because of the dire state of our economy, just hiking those interest rates even more puts the consumer under ever more pressure and really will ruin our prospects of achieving economic growth at all this year by hiking even further, and something that really is very negative for all consumers and the entire economy at broad. Nonetheless, just because the SARB, our Reserve Bank, sees at the forefront of their mandate to protect against inflation, and they see the risks that the currency is just selling off as quickly as it is, it's almost definite that we're likely to see another 50 basis points rate hike come Thursday, another 0.5% that will be increasing our bond repayments and our car repayments and any other credit agreements that we have on the one hand, and that just puts us under more pressure as an economy and as consumers. But on the other hand, that is something that's likely to help protect the currency, perhaps from a further deterioration. At the same time, looking forward, are they likely to raise rates even further? The probability and the likelihood is that this isn't going to be the final rate hike in the cycle, and we could perhaps even expect something more. In terms of therefore trying to price, where are we? Are the bond valuations that we're seeing with the 10-year bond offering a yield of 12%, the currency at 1930, is that a fair value for our currency and our bonds? Is that something that is already included and incorporated in the price of these assets, all of the bad news that we're likely to endure? And this is something that all of us, both analysts, market commentators, investors, fund managers, are all struggling with at the moment, to really try and determine what is a fair value for these investments that and for these instruments that we hold in our funds. On the one hand, you may argue that at 12%, pretty much all the bad news has already been factored in, and how much worse can it get? On the other hand, for example, we know that our membership in AGOA, which is an American trade organization, which contributes about 60 billion rand worth of exports and trade to our economy, is under review in November, and the Americans being very unfavorably disposed towards us as a result of our assistance, or at least accusing us of assisting and aiding the Russians in their war against Ukraine, is a membership that's now coming under review come November. And there is a very strong risk that we may be excluded from that trade agreement by being non-aligned, by not being non-aligned, shall we say, and putting our interests and aligning our interests together with those of Russia, at least from what it seems as the accusations are. Should that happen, that 60 billion rand of trade that would be wiped off, that really is something that would have a very negative impact on our economy. One of the big industries that would be affected, for example, is the car manufacturing industry. BMW, just as an example, Mercedes, I think also, they produce many cars locally and export those to America for sale over there. And should those industries, can you imagine if those industries would come under pressure as a result of a cancelling of those trade agreements, that could then further exacerbate the economic crisis, the unemployment crisis that we find, perhaps increased social unrest, all of these things going into stage 8 load shedding. All of these things are things that one isn't certain have all of these risks and all of these factors been priced correctly already into our bond market and into our currency. And so on the one hand, you've got this massive opportunity of buying bonds offering a real yield above 12%, on the a real yield of 7%, and the nominal yield at about 12%. And on the other hand, we are just not so sure whether all the bad news is already in the price. And so as part of our motto, I guess, or mandate, or that saying that we often share with you, to take appropriate risks at the appropriate time, at this stage in our flexible income fund, we feel that it is probably the most appropriate thing to do to reduce our exposure to fixed rate bonds and rather focus on money market and cash instruments. You know, with the SARB hiking another 50 basis points, that basically puts your cash and money market instruments already able to achieve a yield of 9%, and floating rate instruments will be able to achieve a yield above 10% in that environment. And on the other hand, increased volatility and a further sell-off, where we've seen already this year the all bond index selling off about 4%, is something that maybe is a risk one too far to take. And so at the moment, where we are positioned at the moment with our duration in the fund is at about 2.7, which is less than half of the duration of the all bond index. And that certainly helped us to achieve our objective of outperforming the all bond index with lower volatility. Nonetheless, we do think that at this time, it would be prudent and appropriate to reduce our exposure to fixed rate instruments and perhaps focus on floating rate and cash instruments, that way protecting your investments from downside risk in this environment should we see a further sell-off, and then try selectively to choose those instruments in the fixed rate space that, should there be a rally and should there be a repricing of those instruments, and should there be a catalyst, which at this stage we don't really see either, should there be that catalyst for a turnaround in the sentiment towards South Africa and our markets, then that would then be something that we could take advantage by still being invested in some longer duration instruments in the fixed rate space. That's pretty much in the flexible income side. On the other hand, in our high yield fund, which is a short-term, high yielding income fund and an enhanced cash solution, so this is really the ultimate time and the most unbelievable opportunity for income investors, for those investors looking for a short-term, for a lower risk income opportunity and an investment vehicle that will be able to offer you very attractive returns with very low volatility and almost no downside risk. I don't think we've had a negative month once in the fund since COVID. We had, since the inception of the fund, and with the exception of 1 month after COVID, we've never had a negative month in the fund, and almost no downside risk whatsoever in that fund. So there's an opportunity now, as the SARB continues to hike rates, where as an investor, someone will be able to achieve a return in that fund with almost no volatility of above 10%. So there's a real opportunity on both sides. In our flexible income fund, which is that through the cycle fund, where we're looking to outperform the all bond index with lower volatility, where we now look to focus to protect against downside risk in this uncertain and volatile environment, trying to ensure that we will be able to achieve returns in the region of 10% over the next 12 months. And hopefully with some change in fortunes and sentiment, we'll be able to even outperform that and really find that catalyst for renewed optimism and growth in our economy, where we'll be able to then even push that return even higher into the double digits. Or for those more conservative investors, our high yield fund offering a really attractive 10% plus return over the next 12 months with very little volatility and almost no downside risk.